It's a quiet day for the markets, despite another big raft of scary headlines. This time, U.S. President Donald Trump is openly threatening to fire Fed Chair Jerome Powell, something that, if the markets were to have believed it, would be no doubt a source of epic consternation. But as it turns out, the news passes with a whimper, and the markets head into what is a global deceleration of activity around the Good Friday and Easter Monday holidays, with, of course, Easter in the middle, seemingly taking hold, and the markets kind of settling into a quiet drift. But that doesn't mean that things are actually quiet, and it certainly doesn't mean that we don't have a great big source of volatility brewing in the background. And so what we'll do here today on Macro Money is take a look at some of the data that has fallen through the cracks this week coming out of China, which at first blush might suggest they are all geared up to fight the trade war. I'm going to see if that's in fact the case, how the landscape presents itself. I'm Ilya Spivak, head of Global Macro here at tastylive. And what we're going to do first is just unpack some of the data that has come out this week. There was a big set of releases on the calendar, and they're all out at this point. We should get foreign direct investment numbers at some point over the weekend, but there isn't actually a time of release attached to them, so who knows when they'll be coming out. The data already on the menu looking somewhat impressive, at least at first blush, though, and seemingly suggesting that China is well positioned to resist Washington's offensive. Let's take a look at these numbers here. Exports surging. That's reported earlier in the week, 12.4%, though imports down again, and more than expected, off 4.3%. We'll start to unpack this in just a second. Probably the most impactful number, GDP, the year-on-year rate, 5.4%, unchanged from the fourth quarter, but higher than the 5.1% expected, and blistering numbers for industrial production and retail sales. That perhaps one of the most eye-catching bits of this entire equation here. The number for industrial production, 7.7%, that's the highest since June of 2021, before China exited COVID restrictions. We sort of approached similar levels in January and February of 2022. Again, before those restrictions were over, that was about 7.5%. But clearly, numbers that are significantly stronger than recent history. Retail sales up 5.9%. That's the strongest since December of 2023. So heady numbers here, seemingly. But once we start to unpack them, the story may actually end up somewhat counterintuitive. And these large numbers may in fact be telling us just how concerned businesses are about the trade war's impact. So concerned, as a matter of fact, as to be aggressively front-running them. Now, of course, remember, these are first quarter numbers, so that they don't take in the actual full breadth of the tariff hit, which only is gathering pace in its kind of full and complete impact. Maybe it can, of course, be escalation, but April has really been the timeline for where things have really become spicy here. We are not seeing the full impact of this yet, but looking at the breakdown of GDP, we can see that even going all the way back to the second half of last year. We don't have the full breakdown here for the first quarter just yet, but we can already clearly see in the third and fourth quarter this growing contribution from net exports to overall GDP. And we can see that the final consumption contribution has actually shrunk significantly all the way after this COVID reopening. So the reopening happens right here in the tail end of 2022. The first quarter of 2023, you see that impact with a massive addition from consumption. That has whittled down to very little at all. Capital formation, that is investment, measure of business confidence, has also shrunk significantly. And as we look at the increasing share of exports, even as, especially in the fourth quarter here, you have increasingly combative rhetoric. And of course, now you know who the president is going to be in the US. There seems to be this sense that you have a reason to front run whatever tariffs might be coming. Of course, at that point, you don't know what they're going to be. But you do know that they're coming because they're a feature of the president's campaign repeatedly over and over and over again, and now he's won. So the idea is, well, costs are probably going up, so buy as much as you possibly can now before they do. And that seems to speak to what this surge in net exports contribution to growth is telling us. Now, while we don't know that this is a situation that was exacerbated in the first quarter, again, looking at those trade numbers, that is a fair bet. Because, of course, as we can see here, export growth is accelerating. Meanwhile, imports are not just going lower, but they're already below zero. So not only are imports diverging from where exports are going here, basically since the middle of last year, but imports are actually shrinking, and at a nearly double-digit pace. Of course, the latest numbers here increasingly so in this direction. Imports down 4.3%. That's, of course, not as much as 8.4 in the prior month, but the trend is unmistakable. And so with this in mind, you would, of course, surmise, okay, what is net exports? It's exports minus imports. So you would expect that this state of affairs very much continues into the first quarter and helps to account for this strength. Moreover, it also helps to explain how you have this jump in industrial production. Again, the highest since we were north of 8% back here. Okay, well then what about retail sales? Let's say we can explain away industrial production as front-running the tariffs. What about this jump in retail sales? Surely that means that maybe the consumption component is finally starting to build momentum. And indeed, if we take a look at the internals here, it does seem like there's been a genuine pop in consumption. But why that pop has occurred, of course, matters a great deal. We know that one of the biggest sort of efforts, one of the loudest efforts in China's assorted stimulus measures has been this trade-in program to try to subsidize consumers to swap out older comms equipment, appliances, and furniture for new ones. And we can see very clearly that as we head into 2025 here from 20 to 24, that has given a very significant lift. Indeed, the swap seems to be actually encouraging some activity. But is this activity you can bank on? Well, ostensibly, you swap out your refrigerator and now you're done. You swap out whatever other household appliance or whatever piece of furniture you were looking to replace, and then that's it. This is not an on-ramp, seemingly, for ongoing consumer confidence. And indeed, if we take a look at where we are here on that score, we can clearly see that there's still this widening gap between money heading for so-called time deposits, that is basically savings accounts or CDs, where the presumption is the money is going to be held for a longer period of time, earn more interest, but then be less liquid. And so the idea is this is savings. And then there's, of course, demand deposits, the money that's basically in a checking account and earmarked for near-term spending. Well, you can see that the ratio between these two, which is what we have down here, has kind of oscillated in a stable range all the way back from the global financial crisis into COVID. But once you get COVID, you get this massive increase in money flowing into time deposits relative to demand deposits, and the ratio is approaching almost 3-to-1. That is to say, about 3 times the money going to accounts earmarked for consumption is getting packed away in savings. This is not a picture of consumers that want to be spending money. And so, yes, you might have a retail sales lift here for some amount of time. Of course, it isn't anything like the jumps that we saw even as recently as 2023. This is that reopening jump right here in the first quarter. But since then, retail sales has generally cooled. That makes sense. But this pop right here, much as it seems to be well supported, is just that. It is a pop. It isn't something with runway to continue. And of course, that, at least in general, sort of spiritual terms, as it were, lines up very much with what we're seeing from this jump in industrial production. And that, likewise, to the extent that it is a front-running of the tariffs rather than some sort of a true recovery in demand, that again looks like a flash in the pan kind of a situation rather than something with forecastable scope for continued movement in the same direction. Now, ostensibly, we might see more of the front running. We might see more of an uplift from these incentive programs that China has introduced, but all that's well and good. It's just not the kind of thing that prepares you for a mounting trade war, because it is inherently temporary. And once the tariffs really start to hit, the front running ends and the mood continues to sour. This, of course, speaks to the issue that China has had really since the COVID reopening. And again, here's that telltale moment here at the start of 2023 where you get the last kind of gasp of growth as you get that reopening. And since then, we can see China's economy has basically flatlined. Moreover, the most jarring part of this, as we've talked about extensively before, is that real GDP, that's the darker line here, is running above nominal GDP. That's the lighter line here. And this is the spread. I used different axes here just to show the spread more clearly. You can see here that we're looking at a gap here of about, give or take, 1 percentage point of GDP growth, which is a staggering amount. Because what this implies is an economy-wide deflationary spiral. If real GDP is running north of nominal GDP, and nominal GDP is by definition real GDP plus inflation, well, then nominal should be above real as long as inflation is positive. But if inflation is negative, that's how you get real running above nominal. That is to say, nominal becomes real plus negative inflation. And what you end up with is nominal being discounted by inflation, not have an inflation premium. And of course, that's really the essence of the issue. If prices are falling, if there is in fact deflation, now for 7, maybe 8 consecutive quarters, we don't have the nominal GDP numbers here, but we'll get to estimating them in a second. We have a situation where China is basically relegated to the bargain bin. If there is demand in the economy, well, then people buy things, and that buying of things drives the price of those things higher, as that demand pulls on, at least for the moment, finite supply, and competes on price to get it. So the price of things goes up. Well, what happens if the price of things isn't going up? Well, it tells you there's no demand, and prices need to fall to try to entice it. And what we're looking at now is close to 8 consecutive quarters where that's not working, and prices keep falling and demand remains absent. China is effectively an economy that's attempting to discount its way back to bringing demand to life, and so far, no dice. Now, again, we don't have the nominal GDP numbers here for the first quarter. The real GDP numbers just came out, so we don't have the nominal ones to make the spread calculation here, but we can look at what's been happening with CPI and PPI so far in the first quarter, and we can see that the direction is toward weaker inflation, not stronger, essentially hovering on the lower side of proximity to zero for consumer prices, and the situation in producer prices has only become more negative. It's, of course, been negative since 2022 here, since the middle of that year, and it's never really become very much better. But we can see here that it's actually appearing to deteriorate most recently. So the likeliest scenario seems to be that this situation might have actually become worse, not better, when these numbers are updated. Moreover, the stimulus that China has rolled out is plainly not working. We can see here the share of new loans in GDP continues to be falling. So the Bloomberg Credit Impulse Index here still very much in negative territory. Now, the pace of decline seems to have eased a little bit over recent months, but that's not really much of a positive story. It just tells you that perhaps in year-on-year terms, the situation is not getting meaningfully worse, but of course it also doesn't suggest anything about it getting meaningfully better. So all of the inducements that China has introduced, including, by the way, that trade-in program, are plainly not stoking more credit and more borrowing activity, which, of course, is their aim in trying to revive the economy. Furthermore, and we'll get an update on these numbers maybe over the weekend, foreign direct investment continues to fall at a pace measured in the double digits. So we're again, as of the latest numbers, approaching 20% year-on-year declines, suggesting that capital is pouring out of China as though a ruptured water main. This is a very rapid exodus of capital. And so the situation seems to be that China's economy remains anemic. There's, besides the headline GDP numbers, under the surface, all of the underlying weakness we've seen in recent quarters. None of it seems to be getting particularly improved. And at the same time, the stimulus efforts that have been attempted seemingly not doing much of anything. And so this doesn't really paint us a picture of an economy that's ready for a trade war that now implies tariffs of as much as 145% from the U.S. China, of course, has retaliated with its own tariffs, and that's been an interesting conversation because all of the countries that got a reprieve on reciprocal tariffs above 10% were the ones that didn't retaliate, and or at least walked it back quickly in the case of the European Union. In the case of China, they did not. They've retaliated. In fact, most recently on April 11th, they increased tariffs on goods to the from the U.S. into China to 125%. It's not a huge. It's not going to make a huge difference because of the trade imbalance, but nevertheless, China appears to be fighting back. But the structure of the economy does not seem to suggest they have a whole lot of runway. Moreover, their ability to counter is significantly diminished by their own actions in divesting from their holdings of U.S. treasuries. A lot has been made in recent days of this idea that the reason that the U.S. treasury market is suffering to this extent is because China is actually fighting back against the trade war by selling off their treasury holdings and driving up yields. That this is then creating a potent headwind for the U.S. economy. But what you actually find here is that China has been slowly divesting out of U.S. assets, basically going all the way back to 2010, 2012. 2011 seems to have been the peak. Things held steady until about 2012, 2013. And since then, there has been a steady reduction in China's holdings of U.S. treasuries. And if we look at where those holdings are relative to total outstanding U.S. debt, we're talking about a return back to about 3%, even a little bit less, of overall U.S. debt outstanding. So the lever here does not seem to be particularly potent. Instead, the rise in U.S. Treasury yield seems more about surging term premium. That is, the market's demanding compensation for duration risk around all of this uncertainty in the U.S. It seems to be more a self-inflicted wound than anything that China could have scope to do, considering how little impact they now have on the overall mass of treasuries and the amount that they would need to sell and things that they would need to do to really unwind things to have a meaningful impact. So if we learned anything about this situation this week, it is that the president has mentioned he would like to make a deal with China just today, as he was meeting with Italian Prime Minister Giorgia Meloni and having a press outing. He said as much directly. Meanwhile, China has apparently laid out its willingness to strike a deal. And so, if anything, what all of this suggests is maybe the trade war is heading into a place of de-escalation rather than escalation in the relatively forecastable future, and not because the U.S. is eager to make a deal, but because economic data, headline readings notwithstanding, China's economy is hardly in a position to add a still more aggressive headwind into the mix of troubles it's already dealing with. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go there from. I'll be back for all of that next week. Also, Future Power Hour with myself and Chris is Mondays and Fridays. I'm on with Victor Jones for The Price of Truth on Tuesdays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back next week. Happy trading.